Price to sales ratio metric valuation. A price to sales or PS ratio is a relative valuation metric that indicates how much investors are willing to pay for each dollar of a company's sales. Calculated by dividing the company's market capitalization by its total sales over a specific period, usually the past 12 months, essentially showing how much equity is needed to generate $1 of revenue, with a lower ratio generally considered better. It's particularly useful for valuing companies with a low or no profit, allowing for comparisons with similar companies within the same industry to assess potential undervaluation or overvaluation. Example: Company A has a market capitalization of $10 billion and $5 billion in sales over the past year. Price sales ratio for Company A, 10 billion divided by 5 billion equals 2. Company B also operates in the same industry with a market capitalization of 8 billion and 4 billion in sales. Price to sales ratio for Company B, 8 billion divided by 4 billion equals 2. Interpretation: in this example, both companies have the same PS ratio of 2, suggesting that the market is valuing their sales at the same rate. If Company A had a PS ratio of 1.5, it would be considered relatively undervalued compared to Company B, indicating that investors are paying less per dollar of sales for Company A. Key points about the PS ratio. Industry comparison. Always compare PS ratios within the same industry, as different sectors may have different norms for this metric. Growth stocks. PS ratios can be particularly useful for evaluating high-growth companies that may not yet be profitable, as it focuses on revenue generation rather than earnings. Limitations. While helpful, price-to-sales ratios should not be used in isolation and should be considered alongside other financial metrics for a comprehensive analysis.